Capitalism's cycles in the United States. The JLong wave is a 4-season supercycle of competitive accumulation and debt revolution that coincide with the Elliott wave pattern, which each season have an identical trend direction and historic socioeconomic similarities to parallel seasons in the United States. So what does this mean? There is a cyclic wave contained within the United States stock market that can be uncovered by using technical analysis that signals that our capitalistic social-economic order is cyclic. What is obvious is that when the stock market averages trends higher year over year for an extended period of time, it tends to be an indication of economic expansion and positive wealth effect. Therefore, to the contrary, if the stock market indexes are trending lower year over year, it tends to be an indication of economic contraction and negative wealth effect. A sideways price movement of market averages tend to indicate consolidation, which is a time period where no real addition to the aggregate wealth, but simply wealth changes hand from the left to the right. The following will explain a cyclic socioeconomic timeline that spans over 200 years of historic socioeconomic data, and it explains how socioeconomic circumstances creates each season in a 4-phase cycle that displays a particular market trend direction for each season. Fundamentals of market psychology. At the dawn of modern capitalism, well-known economists such as Adam Smith and Karl Marx saw that the economy was based on greedy competition. In other words, beating the next man for financial gain. Smith saw an economy driven by an invisible hand, and this invisible hand is greed, while Marx saw a system of inequality for the benefit of the propertied class that funnels wealth to the top of a class-stratified system of wealth distribution. He also saw that the ones that owns and therefore controls the means of production constantly increase profits through various means of competitive accumulation that increases productivity while alienating the working class and reducing the laborers to as close as subsistence wage as possible. This would lead to the revolution of the workers in an effort to change the means of production over to the hands of the working majority, which Marx saw as an inevitable impending conflictive revolution. Competitive accumulation is the greedy desire and actions to acquire capital assets at a higher rate of returns than the competition. Built on a greed-based fractional reserve economic order that facilitate and exuberate the invisible hand of greed that traps the economy into a 4-season supercycle with classifications that goes as follows. Autumn, with its euphoric bubble markets producing unstable, accelerating uptrends in valuations, reflecting irrational public behavior. Winter, with its population in a mood of depressed anxiety from an autumn phase hangover of speculation fever, making deflationary corrective markets. Spring, with its production and tension climax while positively inflating markets and income. And last but not least, the social and monetary confinements of summer and its market indexes trading range consolidation period of an uptrend. The all data chart of average stock prices from 1792 to 2012 will be used as a timeline scale for seasons. The turn of the 19th century is the starting point of the measurability of the cyclic wave due to the opening of the New York Stock Exchange in 1792 and the authorization of central banking in the United States that engages in fractional banking practices, which together sets the measurability of this four-phase cycle into play. The central bank centralizes financial power, which enables who in control of it to place major economic monetary agendas, which unfortunately the agenda of major holders of financial powers tend to be the siphon the wealth and resources from the masses and funnel it to the rich, which is the essence of a plutocracy and the natural function of greed. The operations of the New York Stock Exchange differs from the other financial institutions by, instead of siphoning the wealth, it is instead used as a tool to redistribute the wealth through supply and demand, preying upon the greed and fear of the population while displaying the psychology of the populace and market averages. This also tends to help propel and exuberate negative and positive wealth effects, making bubbles and deflationary periods easier to spot in market averages. These events in the 1790s enabled a game of greed, which is the main driver of the four-phase cycle that inevitably serves the rich. The central bank set the directions of inflationary pressures in which the investment community investment decisions are a reflection upon what is transpiring long-term when examining multi-century chart of stock market averages. Many of the founding fathers of the United States opposed the creation of a national banking system. At the time, many saw banking institutions' ability to rob the wealth from a nation by creating periods of inflation and deflation that ultimately siphons the wealth of the masses to the manipulators of the financial system. Thomas Jefferson, our third president, understood this concept centuries ago. The proof is in his famous statement, as I quote, "I believe that banking institutions are more dangerous to our liberties than standing armies. If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. The issuing power should be taken from the banks and restored to the people to whom it properly belongs." Unquote. Even if the power of money creation was given to the public, the chances are that the four-phase cycle would still exist due to greed being the main driver of this cycle. America's first industrial revolution and tech bubble. The first dying growth of the euphoric autumn. Autumns are time periods of irrational exuberance with some type of craze or mania over technological advancements and new social economic lifestyles combined with easy money fueling irrational investment speculation that inevitably collapses. This irrational exuberance stems from the unwarranted expansion of the money supply and over leveraging, causing an inflationary trend in assets of the corporations of the new industrial revolution until unstable asset bubbles are formed. In these time periods, people tend to believe that they are in a new economy with a new set of rules, always believing this time is different. This philosophy tends to bring about malinvestments and make economic social order unstable. Technological advancements that revolutionize the industrial and market base of a nation tend to fuel crazes and manias. In the economic phase of autumn that spanned from around 1800 to 1837, the population had just experienced massive changes in technology and business, which gave way to social economic changes that greater tied markets internationally, which was caused by the onset of the first industrial revolution. The cotton gin, pulling furnace, interchangeable parts, agriculture advances, steam engine, Railways and the factory system gave way for a cultural move away from agrarian lifestyles to urban lifestyles, and in addition, increased the overall productivity of the nation. Steam engines eased long-distance travel across oceans and rivers, connecting markets like never before. As early as the 1820s, tenements were built and populated urbanizing communities. The railroads interconnected new industries, starting with the B&O Railroad, with construction starting on July 4, 1828, and opened the first railway on May 21, 1830. America became a great exporter of cotton to Britain through the cheap expenses of slavery, as Britain was the first to enter the industrial age by opening textile mills, which through an industrial spy, America was able to follow suit. The Industrial Revolution brought about an industrial means of mass communication when the invention of the industrial printing press mass-produced entertaining doctrines and advertisements, also known as newspapers. This new form of media is highly responsible for helping fuel the craze and mania at the time. With the birth of these new technologies, financing the development of these technology was of the utmost importance to advance the industrialization of the nation. With financing new technologies in mind, the autumn phases are time periods that give the ones with wealth, knowledge, and power the opportunity to invest in the ownership of the new technology companies, but leave the expense of building and developing the corporations that are innovating the technological advancements at the expense of the public and a gain on the public. The creation of hypes and crazes in the autumn irrational exuberance phase is in the interest of the corporations and financiers in a greedy game of competitive accumulation. The game is simple. They get in early on the new technology, expand the money supply, create the hype through mass media outlets, and run to safety to get rich while creating a panic, while the lagging investors, which are the public or small investors, are left with the short stick. Later, after valuations are depressed enough in the equity markets, the smart money re-enter into worthy corporations and or assets. These periods can be spotted by their market averages accomplishing accelerated uptrends to a V-shaped top is formed, as with the first autumn phase that spanned from around the year 1800 to 1836. This is the period where the banking power in America sprouted up and began to dominate American business. In 1794, there were 24 chartered banks. By 1837, there were 712. This was a necessary expansion of the banking industry to facilitate the new industrial corporations. This gave the first and second bank of the United States a vital role of facilitating the chartered banks that is a host for the invisible hand of greed in the game of capital accumulation. With using the power of money creation, the Bank of North America, the first and second bank of the United States, the men behind the powers of the bank used their influence to make roller coasters in asset valuations by manipulating the power of money creation. Easy money from the bank brought on land speculation as the railway expanded. In addition, rising speculation in companies tied to the railway industry. Andrew Jackson, our lucky number 7 president, saw the unconstitutional practices of the central bank manipulations from the international bankers infiltrating American politics to playing favoritism in financial and economic affairs. Therefore, he decided to end the money changers' powerhouse and consequently ended the irrational exuberance phase. Jackson was well aware of the central bankers' role in playing favoritism of rich over poor, northeast over south and west areas of the United States, and decided to put an end to it by vetoing the renewing of the charter of the Second Bank of the United States, and required that all land purchases be made in species of gold and silver, creating a deflationary spiral. This ended the irrational exuberance phase by popping the asset bubbles in land and railways assets, and pushed the United States economy into the next economic cyclic phase of winter, also called the free banking era, that lasted until 1860. America's first great deflationary contraction, the winter of 1837 through 1860. Winter is the correction phase in asset prices where there is deflation against hard money and the unbalanced debt structure and economic overages from the economic phase of autumn are rebased for a new economic beginning. Shrinking the money supply causes price levels to fall and generally causes economic activity to slow if there are not enough mediums of exchanges to facilitate the amount of goods and services. By not allowing the Second Bank of the United States to continue its unfair banking practices, the money supply shrank, leading to the Panic of 1837 and the first corrective wave of a three-wave pattern. Banks had overextended themselves on credit to the public for the purchase of land. Just 2 months after the bubble busted, 343 banks out of 850 had failed completely and 43 failed partially. Economic activity slowed as the period of credit and asset deflation hindered economic activity. By 1842, the Depression was somewhat over and the economy began to rebound, with chartered banks expanding the money supply with paper money and with a reduction of tariffs that encouraged international trade. As usual, during the corrective phase, policymakers tried to counter the effects of deflationary spirals, creating an upswing in the correction. This method in the 1840s gave a false positive inflation because the credit deflation was still occurring and the basing of the debt system had not completed its cycle, which left asset prices overinflated due to no new liquidity able to enter those markets. This rebound lasted till the late 1850s until a drop in demand of American agriculture from Europe helped lead up to the Panic of 1857 with the famous bankruptcy of the Ohio Life Insurance and Trust Company. This led the southern states to believe that they had a resilient cotton economy because it was not as affected as the North during the Panic of 1857, which helped build confidence in a secession from the Union. The economic situation that led up to the Panic of 1857 created another down wave in the winter correction that lasted until war production ramped up and the money supply was restructured, which would lead us to spring. 19th century spring phase, the Civil War production and the industrialization in the North. The spring phase is a time period where the debt or money structure is rebased, bringing about positive inflationary pressures, which are stable and valid increases in asset valuations and use values. As greenfield investments are seeded through the implementation of massive spending used to industrialize infrastructure, normally by government spending through the public for military growth due to economic expansionary war. The Civil War brought on an expansion of the factory system and an expansion of the railroad system, which connected resources, industry, agriculture, and residential areas together. This process expanded the real economic structure and allowed a growth. Spending does not have to come from government or do not have to be spent on military to have infrastructure advancements, but it have to fit the agenda of the social economic direction the nation is pursuing, which at the time was conquering the continental frontier. This time period generally is accompanied with increasing real incomes for the majority of all classes due to the implementation of labor being the main facet of wealth accumulation. Shortly before Lincoln became president, tensions between the North and the South over state rights combined with the divergence of economic policy direction, with the northern states wanting an industrial-based economy and the southern states pursuing an agriculture-based one, creating an economic split between the nation that drove tensions up that began to climax in the United States. To fund the war effort, the North and the South made ambitious plans in money creation that helped kick in the spring economic expansion. Lincoln printed debt-free greenbacks to avoid the high interest of the money changers to fund his war efforts, while J. Cooke and Company acted as an agent of the U.S. Treasury, leading a campaign of selling war bonds that netted $1.5 billion, and the South at the time issued cotton-backed bonds, which raised international tensions with the southern states because it rose cotton prices, causing unemployment in Britain's textile industry. This gave the United States a positive wealth effect and advanced industry, particularly in the North, which led to competitive accumulation. Due to greed, there is an overwhelming desire to acquire higher rates of return over the competitor corporations. In the beginning of the economic spring phase, higher rates of returns are achieved by expanding the workforce, by adding greenfield investments into corporations crowd out demand, leaving no new room for new supply. At this point, higher rates of return are achieved through mergers and acquisitions, cost-cutting, and/or competitive inflation. The competitive accumulation process causes the rate of returns to slowly diminish, which inevitably traps the aggregate surplus values of the economic social order into a period of consolidation. This process of lagging returns can be identified by the dwindling returns of the stock market averages that occurred before the crime of '73. In the 1870s, in an effort to overcome the financial impairments of competitive accumulation, corporations formed pools, cartels, guilds, and monopolies, and then combined with the Coinage Act of 1873, also known as the Crime of '73, which permanently ended the economic spring and plunged the nation into the next economic phase, which brings us to the social economic phase of summer in the 19th century, also known as the Gilded Age. The economic summer of the Gilded Age and the Progressive Era social buildup. Summer is a period of competitive accumulation that stems from the crowding out of demand and squeezing on capital, stemming from the need to acquire higher rates of returns. In addition, the great social inequalities during the transition of technology, social life, and debt structure required to accomplish the previous 3 cycles leads to a climax of social strife. During the first industrial revolution, sweatshops were opened and the exploitation of child labor ran rampant. The need for mass population to move into new urban communities inspired the building of tenements that became slums after the neglect from the greediness of the irrational autumn, poverty of winter, and the reconstruction of spring as the population migration occurred. During this time period, child labor, unsafe, unsanitary, and low-paying labor ran rampant. In capitalism, an underclass is needed to keep wages down in the class stratified system. The combination of these conditions led to an awakened generation which guided the United States socially into the Progressive Era. But the economic conditions that led to the social climax in the summer season have its roots in the greedy desire to acquire higher rates of returns, which happened to inspire cartoonists and writers at the time. It was believed over 100 years ago that the Wonderful Wizard of Oz children's story, written by Frank L. Baum in the late 1890s, was inspired by the social, economic, political atmosphere at the time, as the following will partially explain. Throughout the last 3 cycle phases, the factory workers were cut off from agrarian habitats due to social economic changes that trapped the workers in a heartless metallic habitat, becoming growingly addicted to oil as the Tin Man in the Land of Oz. But the factory workers was not the only class of workers to feel the disparity of greedy competition. Since profits were drying up due to competitive accumulation, the banking community had ambitious plans to acquire wealth by contracting the money supply, with the crime of 73 to make loans that many landowners made throughout the Civil War and Spring Phase increasingly difficult to pay back, particularly targeting the farmers, as the bankers engaged in a campaign of land grabbing through the inability of the farmers to pay back the loans due to the deflation of the values of their goods. Letters were found uncovering the bankers' plot over the farmers to lock the nation on the gold standard to land grab from farmers. It's also known to be the motivation behind the yellow brick road and the scarecrow without a brain, because the bankers figured that the farmers were ignorant of economic theories. During the 19th century summer phase of competitive accumulation, greed encouraged the formation of monopolies and political corruption that ran rampant. At the time, there were 2 main monopolistic powers that was believed to be working on the behalf of the international bankers. One was J.P. Morgan with his financial monopoly in the eastern side of the country, and the other power in the western states was J.D. Rockefeller with his monopolistic Standard Oil Company, which was the inspiration for the Wicked Witch of the East and the West, which between the two gave way to slum life and poor living conditions. The Eastern bankers removed silver from the money supply, gave way to the inspiration for the silver, not ruby as shown on television, slippers, which the silver slippers was the power of the witch, just as removing silver from the monetary supply gave the wicked witch or the bankers the power over the farmers. As Dorothy skipped down the yellow brick road, the road signifies the nation was placed on a gold standard. Her silver slippers suggest that Dorothy had the power to reinstate silver as money, to expand the money supply, bringing more liquidity into the economy, creating helpful inflation for the farmers to help them escape the clutches of the bankers or the wicked witches. Dorothy killed the wicked witch of the West with water. Interpreters at the time saw that as killing the plans of the witches or bankers with liquidity. But in real life, the bankers won. In the mid-1890s, there was a movement to help the farmers out of the tight money environment that was led by William J. Bryan, that became to be known as the Lion of the Free Silver Movement. Bryan, the Lion of the movement, political ambitions never materialized, and he was viewed politically as having no courage to stand up to the bankers, and mankind was indeed crucified upon a cross of gold, as he proclaimed would now happen or continue to happen in his most famous speech. The Sherman Silver Purchase Act was enacted supposedly in the attempt to bring liquidity into the market by allowing people to bring their silver to the government in exchange for gold. This action dried up the government's liquidity to the point where the U.S. borrowed $65 million from J.P. Morgan, which leads the way to the Panic of 1893 and 1907. Both of the panics was a crisis of liquidity that J.P. Morgan conveniently stepped in and helped bail out the government by adding liquidity, especially with the Panic of 1907, which paved the way for the creation of the Federal Reserve Act. These temporary expansions of the money supply and new technologies, along with progressive reform, displayed in early autumn in market averages into the installation of the Federal Reserve. The Federal Reserve gave America all the liquidity it needed, just as the second bank of the United States did, which is expansion of the money supply, combined with many new technologies and corporations to support them, helped break the market averages out of its trading range and begun its phase of accelerating uptrends, which brings about the dying growth of autumn that spanned from around 1900 to 1929.